had to get the recording starting. Good morning. Welcome to our Tuesday morning trading session. One moment here as I get the screen share happening. So a very quick overview for those of you who are new to the room here this morning. First off, welcome. Please feel free to ask any questions that you might have about what's going on here. We've got the DTS system here on the NASDAQ. Here in the top left, I have the Hawk Micro Scalper. Top right, Falcon Swing Trader. Bottom left, Eagle Trend Trader. And the bottom right, the Raptor, of course. I'm following the NASDAQ on this monitor. I've also got crude oil and the Eurodollar open. Of course, if there's a market you would like to see, all you have to do is ask. Someone was asking me the other day about the DAX. I can certainly pull up the DAX for those of you interested in that. All right, we'll see here this morning that the market has opened with a little bit of a gap to the upside. Take a look here at the Eagle. Yesterday's trading mildly bullish out of the open. The market did range for the remainder of the day. However, now we're opening up here, so it looks like closing. The market finished yesterday around 5,700, and opening this morning, it looks like at the high of the day at around 57.17. And tailing off a little bit. So we do have a little bit of an opening gap, and it does appear as though the market may be trying to get into that gap. We'll give them a few minutes here to get their bearings. Okay, no signals just yet, but we'll stay with it. It's still very early, of course. We got the makings of a macro pullback signal here in the Hawk. Now the macro pullback signal, of course, occurs when prices retreat back to the macro line. Everything stays in sync except the micro line. The micro line goes out of sync. We just have the warning dot, mind you. We don't have the complete signal just yet. I'm still thinking the market may try to get into that gap. You know that? That's my thought. There they go. They're kind of tailing off a little bit now. 5,700 would see the market trade back toward the hard edge. Actually, just below the hard edge. Okay, so here we have now the full macro pullback signal. Come on, work with me. I don't know if I want to go in for 3 contracts on this. Oh, are they going to move away here? Yeah, okay. Still a macro pullback signal. We are drifting a little bit lower. Because I'm suspicious that the market might be changing trend, I don't want to go in too heavy. So I'll take a single on the trade. And now we've moved into yellow bars, so I'm going to cancel that. All right, so I'm thinking now that maybe we're going to see a test of the extreme, a failure, and that will produce our counter trend signal, the soft edge sell. And that has the potential of being a very good shorting opportunity. Speaking of shorting opportunities, here's crude oil now on the Raptor, and we have produced a soft edge sell signal. It's moved a ways a little bit, but we do have the opportunity for a second push entry. And all that means is that we've allowed the signal to engage, and now we're seeing where the market is reacting. That's the second push opportunity. So if crude oil continues below this bar, it should fall off a little bit lower. You could even enter on the other side of the median line. It looks like right now the market's getting a little bit of support from that zone. But there is a possible trade for you in crude oil. So we're still watching and waiting. Okay, so now we've got the run up a little bit, so we're testing the extreme. The extreme in this case being the high. All right, crude oil is actually rallying away from the signal, so I'm going to close that order out. We'll put that back on the shelf. And now we're getting closer to a possible position here in the NASDAQ, if in fact the market does turn at this point. By the way, you probably noticed that this is our first with trend eagle signal. I think you would want to see a decent second push opportunity here before you get too crazy about going long on it. Unfortunately, you would need to cover it rather deep because of that gap. Certainly somewhere below 5,700 I think would be safe. The better opportunity is to look for a hard edge bounce, however. That's my opinion, of course. All right, so they filled that eagle trade. Let's see if we get some follow through on that. The real obstacle, of course, going to be the high of the morning. $57.17. That's the number we want to close above. If it looks like it's going to start to flounder, I will bring my stops in quickly because then it has the potential of being a double top. So I'm eyeing this swing low now as my stop territory. That's still, a fair amount of open risk. I'm still giving the market a reasonable chance to rally from here. I'm going to do my best to be patient with the market and not tweak myself out of a good trade, as I have a tendency to do from time to time. There's also now a first micro-macro cross here in the hawk. And you might be looking at this and saying, well, Eric, how can that be a first micro-macro cross? The micro line and macro lines never crossed over. Well, everything went out of sync. Well, I guess technically the filter didn't go out of sync. So maybe it's technically not the purest first micro-macro cross signal. But 3 out of the 4 went out of sync. Your bars are out of sync. Your trend line is out of sync. Filter stayed in sync, however. We're kind of getting held up on the highs now. Or I guess, a new high. Just, what are we sitting at? 57.18 3/4. Some pretty high numbers. David asks, is there a reason that you don't have the support and resistance lines on the hawk? It's just for clarity's sake, David. The values will be exactly the same. But because, you know, here in the trading room, I try to keep things clear, I've only put one tool on each bird. So the hawk has got the day ranger, the falcon has the support and resistance lines, the eagle has the trade forecaster, and then the raptor has the Geiger counter. And of course I do have the support and resistance suite here on the raptor as well, because I know a lot of new raptor owners have the support and resistance suite on there also. But yeah, it's just for clarity's sake. I can always see the values just by glancing over at my other chart. Well, this is becoming a little annoying that they're taking so long to rally it up a little bit. I'm so tempted to trail my stop just below 57.15. It's all I can do not to not to adjust it. John's asking, how much do you value support and resistance when it's combined with the Raptor? Well, a lot actually. Now, these support and resistance lines, they work very well as you can see. You know, they pin the market pretty well, but they are forecast lines. You know, sometimes as traders, we have the habit of getting so involved with the mechanics of trading that we forget to react to what the market is doing. So these lines are forecast for today, and I will respect them in the sense that I'll use them as profit targets. I'll use them as zones where I may see the market react and confirm a signal. So if the market is going to rally today, of course, it's not going to respect the resistance as much as the support. That's kind of the whole definition of an uptrend. Is the market honors support, but it doesn't honor the resistance. So you can see even here this morning, prices came down, gave a little bounce, came up, produced a buy signal. Now it's not one of our 3 high probability buy signals that we look for, but it is still a buy signal, and you could look at it and you can say, well, all right, it bounced off of the resistance line, the secondary resistance line. I might try to buy that one up. You're not going to be able to see it very well here because of the cloud, but the primary resistance line from yesterday runs right through here, and it sort of confirmed the number 1 buy signal, and it certainly confirmed the number 3, the hard edge bounce signal, because it came down, hit the primary resistance line right to the number, and then bounced higher. When you see this type of thing happen, people are often confused and they say, well, where should I go for a profit-taking order? I find them really helpful in that respect. If you have no idea where to take profit, take a look at the next resistance zone. Or if you're really ambitious, go 2 zones out. So the primary resistance was right here at 56.96. First zone higher is 57.02. That seems like a very safe scalp. And if you wanted to go for a second target, 57.08, right? So you could set up your trade something like this. Let's say we were going to take 2 contracts, and we're going to do it like this. There's target 1. Oops. Try that again. There's target 1. Oh, doggone it. What are you doing to me? There we go. There's target 1. There's target 2. Now you can see target 1 is essentially a scalp target. And then target 2 would be more like a swing target. And it didn't get there until the overnight, but it did get there. Different people like to use the support and resistance lines differently. You know, some people who are not trading the DTS system, who are simply trading like a tick chart or a time chart, they'll look again for that reaction. They'll look for price to close above or below a resistance area, and then take that trade accordingly. So I do give them their due, but at the same time, I'm also conscious of the price action. I'm always looking for that failure, you know, that test of the extreme that would suggest the market is possibly going to reverse. Always looking for pullback opportunities to buy, because as you've probably heard, pullbacks are your best buying opportunities. It takes a little getting used to, especially when you're brand new to trading. Oh, they're just driving me crazy here. Get up there. Yeah, I know Keith is complaining here how slow it is. He says, this isn't even summertime. For those of you who are unaware, the markets get dreadfully slow after school lets out in the summer. So end of June, early July, all through August, this is kind of what we're in store for. This is not typical for this time of the year. All right, I've had enough. I'm taking the trade to break even. Stop me out if you will. David's got a good question here. He asks, I hear the term scales being used in too many ways. Can you please give us your definition of these primary trading time frame terms? Scalp, swing, position, any others? All right. Just one second, just making a note here in my journal. All right, so David, you're absolutely correct. Terms like scalping, swing trading, trend trading, end of day trading, position trading, they're all kind of relative and everybody has their own definition of them. I remember a trading friend of mine who used to trade the cattle pit in Chicago, and his co-workers thought he was a position trader because he would hold on to a trade for as long as 5 minutes. Say it isn't so. So of course, you know, if you're trading in the pit, you're in and out probably 30 seconds, maybe a minute, because you're just looking for a quick profit. And that's how I tend to define scalp trading, swing trading, position trading, trend trading, and so on. It's by your profit objective. A scalp target is typically $50 per contract. Because it's a relatively small objective, scalp traders are usually only in a trade for, well, usually no more than 5 minutes. When the market's a little sluggish like this, you may have to hold for as long as 10. Sorry, I had to clear my throat there. Swing trading, on the other hand, tend to hold on a little bit longer. They tend to have a slightly higher profit objective. My definition for a swing trade is $100 per contract. Now, some swing traders will disagree with that. They'll say that you need to have a larger profit objective than that, but typically it's $100 or better. And swing traders tend to hold on through multiple pullbacks. That's the other definition. That's why they're called swing traders, because they will allow the market to swing against them as they try to swing it higher. As a rule of thumb, scalpers don't let the market swing against them. Scalpers get in, they get their profit target, they get out. Scalpers are not. So a scalper might be looking at this trade down here. They get in, they get their profit objective. They're not keen to let the market move against them even a little bit. All right, so that's another way of looking at a scalper. A position trader is somebody who normally trades longer time frames. And by that, I mean usually end of day charts. Although, as I mentioned about my trading friend, Scott, that, even in the cattle pits holding a trade for 5 minutes, they thought he was a position trader because he held it that long. But usually position trading refers to traders who are looking at least at a daily chart, and more often than not, even looking at a weekly. They are prepared to ride out multiple swings against their position, and they tend to have a much larger profit objective and a much longer time view of their trade. So a position trader trading a stock index is bare minimum looking for a $500 per contract return, and typically $1,000 or better. And it may take them anywhere from 3 to 5 to 10 days to get that objective, depending on how the market is moving. Trend traders, at least for our intraday definition, again, have a larger profit objective. For my definition, it's somebody who's looking at $200 or more per contract. And again, trend traders typically will have to try to ride out a market swing or two. So let's say we took the trade down here out of the open. The market did go up and hit the profit objective, but let's pretend for a moment that it didn't. It would not be uncommon for a trend trader, to ride out a swing here, to ride out a swing here, to ride out a swing here, to try to get to their profit objective. Of course, they would be watching constantly for breakdowns in support, tests of the extreme, possible failures, and then they would adjust their trade accordingly. There is no right answer. There is no best way to trade. Don't let anybody tell you. Some people really get married to their trading styles, and they think that's the only way to trade. And of course, that's not true. There's lots of ways to make money trading. The best way is the one that's most comfortable to you. I know traders who cannot stand to let the market run away on them. If they're in a trade and they take profit, I think this is what happened the other day. So they're in a trade, they take their trade, they take their profit, they cannot stand it if the market moves without them. It really burns them that the market got away and left them without more profit. Okay, if that's you, then you're probably going to have to be of the swing trading or trend trading variety. Then I know other traders who cannot stand to have the market take open profit away from them. So, you might be in a trade and you may be up $50, $60, but then the market starts to pull it all away and takes it all away from you. And I know traders that gets them bent right out of shape as well. So I guess, like I said, it doesn't really matter. There's a lot of ways to get the job done. It just depends on which one suits your personality the best. John's asking, how would you use the Raptor for trend trading? Looks like everything is there. Yes, the Raptor, of course, is a combination of the other three trading birds all put into one. Well, like I said, John, it kind of depends a little bit on your profit objective, as well as how many swings you're prepared to ride out. So if you took this hard edge bounce signal down here off the London Open, and you're still riding out these swings and you're prepared to ride out the swing that's coming, well, that would make you a trend trader in my book. And also, like I said, it depends on the profit objective. So if you're looking for a larger profit out of the trade, right now I only have my profit set at 20 ticks, but let's say you wanted to go for a 40 tick target. That would make you more of a trend trader as well. Like I said, the trend traders, they tend to hang in a little longer. They're prepared to ride out multiple swings in order to get a larger profit objective. Swing traders will usually take at least one swing against their position, and scalpers typically don't take any swings against their position. And it's, you know, of course, it's easy to trade in hindsight, but let's just pretend here for a moment. So this is our entry. Here's our initial stop loss. The market comes down, swings against us, rallies up. So at this point, if I were a swing trader or a trend trader, I would probably bring my stops up here to break even. But look at how much open profit there is. There's probably like $150, $200 in open profit there. As a trend trader, you're prepared to let that get away on you in hopes of bigger gains. So here comes the next swing. And okay, it turned just in time. Oh no! See, so you get tagged at break even. And what happens then? The market starts to bounce around a little bit, but I think it does go higher from there eventually. Like I say, there's no right answer. There is no best, in spite of people always begging you to show them the best way to do something trading related. The only best is what works best for you. All right, so we have now our counter trend signal. And David, I'll get to your question here in just a moment. Okay, so David asks, but can't a trend type profit target be accomplished via a scalp position trading method to steal the best of a longer run without the exposure of a swing or trend approach? Well, yes, of course it can. Like for instance here, and I suppose the best way to do that is through multiple contracts. So right now on the Raptor, I can afford to be short 2 contracts. So I have a profit-taking target at my traditional swing objective, which is 20 ticks out, and then I have the other one open as a runner. So if the market falls off, say to the median line down here, 56.98.5, that gives me the potential for picking up a little extra profit. I think it's a little bit more difficult to do as a single because single contracts are just very, very difficult to manage. Like for instance, if we were trading a single, okay, I have my scalp target. Do I take it or do I hold on? What do I do? And of course, you can't trade in hindsight, so you have to make these decisions all the time. But yeah, if you're able to trade more than one contract, I get your point. But don't get too hung up on the big dollar amounts. I know, sometimes I shoot myself in the foot here in the room as well. And partly, I'm trying to look like a rock star holding on for these huge moves. But in actual fact, remember, you only need 2 $50 trades a day. Now, if you can do that, if you can net $100 on the day, and you can do that every day, over the course of the year, you will earn $20,000 per contract on 2 $50 trades a day. Now I know there's commissions and fees and whatnot in there, but let's say for easy math, $20,000. So now it becomes a numbers game. That's on a single contract. If you're trading 2 contracts, that's 40,000. If you're trading 3 contracts, that's 60,000. If you're trading 5 contracts, that's $100,000 a year on 2 $50 trades a day. And this is the part that escapes most people. Most people are like my cousin Marvin, and I love my cousin, but he looks at a chart like this and he says, man, Eric, if we had bought it down here, and, it went all the way up here, think of all the money we made. The reason I laugh is you obviously don't know my cousin Marvin, but there is no way on earth that he could survive a pullback like these. These are substantial pullbacks. He would be pulling what he has left of his hair out during these swings. There is no way he could stomach those. So again, I think it boils down to what type of trader you are, what kind of trading suits you. But don't get that production line mentality that says, oh, I've got to trade 10 times a day. Why am I not taking this signal? Look at what happened. The market went up. Why didn't I take that signal? I could have scalped out. Yeah, you could. You could certainly do all those things. But as Ray Burke always used to say, trading the left side of the chart is easy. Trading the right side of the chart isn't quite as easy. But remember, it's not It's not quantity. You don't need any more than 2 trades a day. And you can even get by on 1 day. And yes, the home run trades are great. I love them. You know, the market broke the resistance zone here. I'm looking at the median line now as a profit-taking objective. I'll look like a rock star, right? But the bread and butter trades are your little $50 winners, your little $100 winners. Here we're just kind of plodding along here. Let me see if I can find this. All right, Indicator Warehouse made this great little tool called the Money Expert. And what it does is it shows you the power of position sizing. So you've got Joe here doing, starting with $10,000, 100 trades later, he's up to 17,000. So Joe hit a really good run. But if Joe had used position sizing, mathematically at least, he could have ran that up to about, a little over $100,000. Now, these are randomly generated, so don't think it's fixed, but here's the whole point of the matter. You start with $10,000, you're risking only 2% of your capital. You're only right half of the time. All right, this is a tool to show you how important it is to do correct position sizing. Okay, this is an interesting curve. You start at 10,000, you're up at a little over 13.5. Position sizing or trading singles did nothing for you. You ended up in the same place as Joe did. Same thing on this one. Okay, this one, the green line is the position sizing. You can see your drawdowns were a little bit more exaggerated, but so were your winners. And this, again, is a very realistic curve. At the end of the day, you and Joe end up in the same place. Let's try this one more time. Okay, this is a pretty good curve. So you've got some winners, you've got some losers. You and Joe are lockstep until about 70 trades in, and then the power of position sizing starts to take over. And Joe finishes, looks like about 14.5, and you finish at around, we'll say 16.5 for easy math. If you click on the chart, however, this is the point I wanted to make. Look at the trades. Okay, there's a big one there. There's a $350 winner. But look at the trades. They're all your bread and butter type trades, right? There's nothing huge in here. Oh, there's another $300 winner. So it looks like the computer generated, and these are random, about every 15 or 20 trades, you get a little bit of a home run. Oh, here's one about 20 trades later, you knocked it out of the park for 500. But the rest of them, you know, $125, here's a little $50 trade, here's a trade for $87.50, you know, here's one for just shy of 140. This is the point I wanted to make. It's these bread and butter trades that make the difference. The home run trades don't happen that often, and anybody who has traded for any length of time knows that. The home run trades are great, but if you're looking to capture those big moves, you really have to have a longer perspective on your trading. And most people don't. Most people don't have the nerve to ride out those kinds of pullbacks. Most people, yours truly included, doesn't have the nerve to ride out a $90 pullback. I would be sorry to give back the 90 bucks. That's why my stop is where it is. I don't want to give back the $90. That's a half-decent bottle of hooch. You know, I want that. That'll pay my my hydro bill this month, my electric bill this month. for those of you unfamiliar with the term hydro. Yeah, Tony says bread and butter versus steak. And you know, like I say, the big moves, they're fun if you catch them. I've caught some huge moves in my day. There was one feeder cattle trade that was good for the nearly $10,000. It made me feel really good, but that's not the trade that keeps the lights on, right? It's the $100 here, $300 there. Those are your bigger opportunities. But, you know, like I said, that's me. If you're more comfortable, if you're more comfortable being short here with your stop up there and you're looking for a profit target down here, then by all means, go for it. Leave your stop at break even. Let the market move against you and potentially stop you out, or even stop you out for a $300 loss. Leave your stops back there until the market, makes really good progress. And there are traders that do that, for sure there are. It's just not for me. I'm not wired that way, that I can trade that way comfortably. David's asking, so for Raptor traders, for a more conservative approach, just wait for the number one entry signal? No. Well, unless you're meaning right now, waiting for the number one. The number one signal is the cloud crossover signal. It tends to develop at the beginning of a trend. Your number three signal is your continuation signal. It tends to develop when the trend is already in play. And then the number two signal is your counter trend signal. In hindsight, we probably should have labeled the number one signal the trend start. The number two signal should have been the continuation, and the number three signal should have been the counter trend, but whatever. When the Raptor prints these signals, these tend to be your high probability signals that you should be able to take with a great deal of confidence. You can see that at the moment the Raptor is also printing a signal here. It is a valid signal. It would be what I would consider to be an early cloud crossover signal, an early number one. The reason I'm not all excited about getting on board there is because I might need to ride out a swing. There very likely is going to be a test at the extreme here before the market attempts to resume the downtrend. I don't really feel like riding this part out. I would rather try to get in on this part here when the market starts moving lower. So that's why there was no signal printing or high probability signal printing off of this signal right here. Does that mean you cannot take that signal? No, of course not. Just be prepared that if you choose to short down here, your stops are going to have to be up here because you may endure a little bit of a pullback as the buyers try to recover the trend. But as a new Raptor trader, yes, if you stay with the high probability signals, those are the 1, 2, and 3 signals, you will find yourself on the right side of the trade more often than not. Now, you do need to balance the signals with the context of the chart, and I spoke about this the other day. The market was a lot choppier when we were addressing this. Allow me to dial back here a couple of days. even these are getting decent follow through. But if you're looking at your chart and it has no discernible trend and it just looks like it's going up, it's going down, it's going up, it's going down, you need to balance the context of the chart with your signals. So yes, I'm getting a number one buy signal here. Technically, it is a cloud crossover signal. Does that mean it is not worth taking? No, of course, it is worth taking. It is a high probability signal. But again, you need to balance that with what's going on in the chart. Right now, the market not really showing much of a trend, right? If anything, you may say the market is kind of in a rather large trading range. So how do we handle that? Well, the easiest way to handle it is to allow the market to break out and then look for a follow-up signal. Right? That's the easiest and most reliable way to trade this. But let's say you did not do that. All right, so what should you do? Well, you need to contain your risk. And so here's your signal. Where's the best stop? Well, the stop right here is okay, but the best stop is down there. So if you can afford this trade, well, then you should take it. Now, just because your stop starts down here doesn't mean it needs to stay down there. But you know, you need to have a reasonable stop. See, if I placed my stop just below here, look at what happened. The market came down, did not give me any opportunity to adjust the trade, came down, stopped me out, and then reversed. This is why it's important to have a stop that sits a little bit further away. Typically, I like two swings back. So here was swing one, this was swing two. And after that, it becomes a matter of logistics. In other words, if you can afford the trade, take the trade. If you can afford the risk, take the trade. So at this point now, I may choose to roll my stop in, and the market comes up a little, starts to flinch a few more times. Well, we're in the overnight now. I've got a few opportunities here to adjust my stop. Let's say I just kind of ride it out, and boom, I get tagged, and I get stopped out for about $200, it looks like. Okay. I was wrong about the trade. It was a signal that did not have any follow-through, and it did not follow through, of course, because of the context that was preceding it. But if this was 2% of my capital, then this loss here is probably close to 1% of my trading capital. Those types of trades are not the trades that are going to ruin you. Right? The losing 1% on a trade, okay, it's unpleasant. I lost $200. It's KD for dinner tonight. But my point is that those types of trades, like I said, are not going to ruin you. It's the trades that you get lopsided on those are the ones that are going to hurt. David's asking, what are these green dashed lines that you have? These are the initial balance lines from Indicator Warehouse. Just one second, I'll see if I can't direct you to those. Stop it. Okay, so these are the initial balance lines from Indicator Warehouse. You can just go to Indicator Warehouse and search initial balance lines. And what they do is they identify the opening range. I have them set to identify the high and low of the first half hour of trading. The logic is that the first half hour is when the big boys, and I'm using air quotes when I say that, place the majority of their trades. Some traders believe opening range actually extends to the first hour of trading. You could certainly set them to identify the first hour as well. The idea is that these will now act as support and resistance throughout the day. So you can see here was the high of opening range yesterday. The market still did get higher, but it flinched a few times as it hit that zone before finally breaking through again. All these toys, all these indicators are all well and good, but at the end of the day, it always boils down to the same thing. Does it help you make a trading decision? If it does, then by all means, go ahead, use it. If it doesn't, get rid of it. Mike Filigera, for instance, likes to use fast stochastics on his chart. Only guy I've ever known to use fast stochastics. A lot of traders like slow stochastics, but Mike puts fast stochastics on his chart. Okay, does that help you make a trading decision? It does for him, but do you need it? No. If it's only there to confuse you, get rid of it. I was speaking to a fellow just the other day, or actually emailed me, and he showed me his charts, and I wonder if I won't get the email. But he had so much stuff on his charts. He was watching like 4 indicators, and then he had moving averages, and I think maybe he even had Bollinger Bands on his chart. I forget. There was a lot. There was a lot of stuff on his chart. And he was talking about stacking MACD indicators at different settings to help confirm a signal. And it made no sense to me. I told him, as I will tell you, if your objective is to eliminate all losing trades by tweaking your signal, that is a rabbit hole you will never emerge from. It's impossible. And I don't mean that in throwing down the gauntlet type of idea, but it is. It's impossible. The market will always adjust. If you did find some magical setting or indicator, the market would adjust. Trust me. right, hold on a second here, David. I got your question. Kame is asking for the 30-year bond, and I'm sorry, I'm probably mispronouncing your name. As someone who has had their name mispronounced their whole life, I feel for you, and I apologize. So here's a 30-year bond on the Raptor now. And we got a nice little hard edge bounce signal right out of the open, and a good little rally up. You can see we've moved 1, 2, 3, 4 zones. You'll notice here on the 30-year bond, I've gone with the faster settings. So these are the 4, 4, 6 settings. So that means we've got a 4-tick chart. And on the Raptor, in our indicator panel, we've got a 6-tick brick, a 4-tick brick, and a 4-tick hawk. Now, if you're serious about trading the bonds, you could even speed that up some more. You could go to a 2-4-4. So that means a 4-tick and a 2-tick cloud and a 2-tick hawk. And you could even change your brick size to 2 ticks as well. It's going to give you a few more signals, perhaps allow you to cover the trade a little bit more aggressively. So you can see that number 3 signal on the longer time frame, or pardon me, the 4-tick chart, turned into a number 1 cloud crossover signal on the 2-tick chart. Bonds are a great market to trade. They say bond traders are the smartest traders in the world. So I would have a hard time holding on for such a long time. But at $31.25 a tick, you don't have to be in the market very long to realize a decent profit. But it looks like a fantastic move out of the gate. So it looks like it started at 151.10, and now we're up at 152. That's huge. That's huge. All right, David's asking, Eric, Ninja reps are actively warning us traders opening new accounts with intentions of trading based on indicator add-ons, indicator warehouse or others, that paper trading stop strategy fills are often nothing like real market trading stop fills, and we should be ready to see the markets turning against us to blow right by our safety stops, even to place fill at market. Please clarify this is a serious concern. Okay. It's essentially the broker's way of covering his backside. It's just like all those forms that you fill out when you open up an account, warning you that you can lose your shirt and then some, futures risk is unlimited, and so on and so forth. In a quickly moving market, yes, it is possible that the stops will be blown and you'll get a horrible fill, much worse than the one that you intended. So for instance, here on this hard edge bounce that we're printing right now, my intended stop would be 56.96. There is no guarantee I will get filled at 56.96. If the market plummets, right, I may not get an order until 56.82. That is a very realistic possibility. Now, it would take something of a catastrophic nature for this to happen. There are market makers whose responsibility it is to keep the market liquid, and they have to take your order. So if the market falls apart and trades through 56.96, they have to fill my order, but they do have the option of filling it at an amount that they are comfortable with. The market makers, if you've ever read anything about them, they know the heartbeat of the market better than anybody. So it is a realistic possibility, and one that you have to be prepared to accept. However, in actual fact, it's very, very rare. I don't know. I haven't ever experienced significant slippage. Maybe those of you in the room this morning, if any of you have had significant slippage, you can chime in. I was working with a fellow who was trading crude oil through Interactive Brokers, and he was routinely getting slipped 8 or 10 ticks on his orders. And I told him, you had better call your broker, because a 1 or 2 tick slip, okay. In crude oil, 3, okay. But 10, no. 10 is wrong, especially in a market as liquid as crude oil is, and no pun intended. But like I said, it is a real possibility, and the futures brokers are essentially just making you aware that, hey, this is a real thing. This can happen, just like the market may move lock limit against you. That's one reason I rarely trade the meat markets, is there is a very real possibility the market can move lock limit against me. I've seen it hold for as many as 3 days before the exchange will widen the lock limit parameters just to get the market trading again. But I can have 3 days in a row of max drawdown. Or if I find myself on the right side of the trade, 3 days of max profit. But the point is, there's nothing I can do about it. And I need to know that going in, that this is a very real possibility. The only way around that is to trade options, because options have your risk value in the option premium. Essentially, what you've paid is the maximum you can lose. However, options have a whole other host of problems. Just because you may have an option here to buy, you may have a put option down here at 56.90, and that's your stop. Again, if the market falls, you may not get anybody who wants to buy your 56.90 option. You may not get anybody who wants to buy it for 2 or 3 days. And meanwhile, the premium on it keeps eroding, keeps eroding, keeps eroding. So I know you pick up down here, but yeah, there's all kinds of things going on. Well, actually, no, that's not entirely correct how I did that. If you have a 56.90 put option, sorry, and the market plummets, this here is your risk amount. That's how much you've lost, because your 56.90 put is earning money down here. Sorry, I made a mistake explaining that. But the option you bought here, that one's not doing so good. So at the end of the day, you know, you've still lost this amount through here. It is a game of risk, folks, and there's no two ways around it. You have to go into it with your eyes wide open, but like I say, unless something catastrophic happens, realistically, your stops will be filled pretty darn close to where they're supposed to be filled. All right, folks, I need to close up the room. I do have a meeting at the top of the hour, so we'll do this all over again tomorrow, and I will talk to you Wednesday. Bye for now.